Bitcoin just fell to about $59,000. More precisely, around 59,024. That is its lowest level since October 2024. It is the third time this year it broke below 60,000. Each time, the same number became a wall. This is now roughly the 8th month of a bear market. The asset they call digital gold is sinking. So today, the story behind the money. Here is the question that breaks the whole pitch. If Bitcoin is digital gold, why is it falling? Because in 2026, real gold hit record highs. The fear that should help a haven was everywhere. The haven went up, the so-called haven went down. That single contrast hints at what Bitcoin really is. Let's start from the beginning. Bitcoin is money with no government behind it. No central bank prints it. No country controls it. It lives on a shared public ledger called a blockchain. Think of it as one giant spreadsheet everyone can see. Thousands of computers worldwide keep that ledger honest. They constantly check each other's copies for fraud. Nobody can quietly change the rules or fake a balance. That decentralization is its core selling point. And there will only ever be 21 million coins. That cap is written into the code itself. It is a hard ceiling, not a guideline. No politician can vote to make more. Compare that to dollars, which central banks can keep printing. Print enough money, and each unit buys less. Scarcity, supporters say, is what gives it value. It is gold, they argue, with a fixed, knowable supply. New coins are released slowly, as a reward to miners. Miners run computers that secure the network. In return, the system pays them in fresh Bitcoin. About every 4 years, that reward is cut in half. This event is called the halving. Each halving makes new supply scarcer over time. Believers see every halving as fuel for the next boom. It is the heartbeat of the digital gold story. Put it together and you get a powerful pitch. Scarce like gold, but easier to move and store. You can send millions across the world in minutes. A hedge against reckless money printing, supporters argued. A safe place when stocks and currencies wobble. That promise pulled in millions of believers. But promises and price are two different things. Because Bitcoin's history is anything but calm. It does not drift, it explodes, then collapses. Boom, crash, silence, repeat. A true believer needs an iron stomach. To understand today, you have to see the cycles. There have been 3 big ones already. Start with 2017. In 2017, Bitcoin roared toward 20,000. At the start of that year, it was worth under 1,000. Everyone from cab drivers to bankers wanted in. It was the first true mainstream mania. Headlines screamed that this changed everything. Fortunes were made on paper overnight. And then the floor disappeared. Over the following year, it lost roughly 80%. 80% of its value gone. Picture $20,000 becoming about 4. The believers who bought the top were crushed. Critics declared Bitcoin dead again, but did not stay dead. It came back bigger than before. By November 2021, it hit about 69,000. This time, big institutions joined the party. Some companies put Bitcoin on their balance sheets. A few countries even flirted with making it legal money. Cheap money everywhere was chasing every risky bet. Digital gold felt unstoppable. It was, in fact, very stoppable. Through 2022, it crashed towards 16,000. Central banks raised rates, and risky bets bled out. Suddenly, cash-earned interest and speculation looked foolish. Major crypto firms blew up and went bankrupt. The supposed safe haven fell with everything else. Notice the pattern hiding in plain sight. Bitcoin booms with risk and dies with risk. Then came a turning point in January 2024. U.S. regulators approved spot Bitcoin ETFs. An ETF is just a fund that trades like a normal stock. Now ordinary investors could buy it through a brokerage. No wallets, no passwords, no fear of losing the keys. Wall Street money poured in through the front door. It felt like Bitcoin had finally grown up. But growing up cuts both ways. An ETF lets money rush in when times are good. It also lets that money rush out when fear hits. With one click, a fund can sell what it once bought. The same plumbing that lifted Bitcoin can drain it. And in 2026, the money started leaving. Which brings us to right now. Why is Bitcoin falling today? For forces are squeezing Bitcoin at once. Capital is fleeing crypto for other bets. A war is feeding inflation fears. Investors are pulling cash out of Bitcoin ETFs. And confidence across crypto has quietly cracked. Alone, each is survivable. Together, they are heavy. Let's take them one by one. First, the great rotation out of crypto. Investors are chasing the shiny new thing instead. Money is pouring into artificial intelligence stocks, into hot new IPOs, and into prediction markets. Speculative cash always hunts the next big story. There's only so much of it to go around. Bitcoin is losing the fight for attention. Second, a war is rattling the global economy. The conflict involving Iran is stoking inflation fears. Conflict can lift energy prices and unsettle trade. Higher prices usually mean tighter financial conditions. And tight conditions punish the riskiest assets first. If Bitcoin were truly digital gold, war might help it. Instead, it is getting hurt. The wider market is flashing caution signals. Oil prices have been swinging on the war headlines. Bond yields have wobbled as traders hunt for safety. When investors get nervous, they call it risk-off. In a risk-off mood, speculative assets get sold. Bitcoin sits right at the top of that list. Third, those Bitcoin ETFs are now bleeding cash. Spot Bitcoin ETFs are seeing steady outflows. When investors redeem, the fund must sell coins. Selling begets lower prices, which begets more selling. Some institutional buyers of yesterday are stepping back. The front door that let money in is letting it out. And that erodes the final force, confidence. Fourth, and hardest to measure, is belief. There's a broad loss of confidence across crypto. Bitcoin has no factory, no profit, no boss. Its price rests heavily on shared belief. When a market runs on faith, doubt is contagious. Fewer new buyers means fewer hands to catch the fall. The story that lifted Bitcoin can work in reverse. But the deepest tell is somewhere else. Here is the moment the whole thesis is tested. In 2026, real gold hit record highs. War, inflation, and fear sent investors into gold. That is exactly what a safe haven is supposed to do. Gold has played that role for thousands of years. And in the very same storm, Bitcoin sank. Digital gold did the opposite of gold. So what is Bitcoin really when the pressure is on? So far, it has behaved like a risk asset, not a refuge. It tends to rise and fall with tech stocks. When investors get greedy, it often soars with them. When they get scared, it sells off with them. A haven is supposed to zig when markets zag. Bitcoin keeps zigging right alongside them. That is the pattern the data keeps showing. Why would digital gold track the Nasdaq? Both are bets on the future, paying nothing today. Bitcoin has no earnings, no dividend, no yield. You only profit if someone later pays more. Its price rests almost entirely on demand. So it floats on the same tide of cheap money. When that tide goes out, both fall together. To be fair, the believers are not crazy. The supply really is capped at 21 million. The halvings really do shrink new issuance. ETFs really did open the door to big money. And no single government can switch it off. It works the same at 3 a.m. on a holiday. Those are genuine, durable strengths. Supporters also point to the long arc. Every past crash was followed by a higher peak. 20,000 became 69,000. 16,000 once felt like the end too. Bear markets, they say, are just where patience is built. Past cycles, of course, do not guarantee the next. But the history is not nothing. But the skeptics have hard points too. Bitcoin pays no yield and produces no cash flow. Its volatility dwarfs almost any major asset. Double-digit swings in a day are normal here. It keeps trading like a risk-on tech bet. And sentiment can flip on a single headline. So far, it has not behaved like a reliable hedge. Two wild cards hang over everything. Regulation can lift the market or chill it overnight. A friendly ruling can spark a rally. A crackdown can erase gains just as fast. And raw crowd mood still moves this market hard. Faith, here, is part of the fundamentals. Maybe both sides are partly right. Bitcoin can be a real innovation in money and still trade like a speculative risk asset, scarce by design, yet volatile in practice. A long-term bet wrapped in short-term chaos. A young asset can grow into a new role over time. The label digital gold may simply be premature. So what would actually change the story? Watch whether ETF outflows turn back into inflows. Watch if Bitcoin ever splits away from tech stocks. Watch interest rates and the path of inflation. Watch how it behaves the next time fear spikes. And watch whether confidence quietly returns. Those signals will tell the next chapter. This crash is more than a price move. It is a live test of the entire pitch. To earn the digital gold name, it must act like gold. That means holding firm exactly when fear peaks. In this storm, gold rose and Bitcoin fell. The thesis is not dead, but it is unproven. The next cycle will likely settle the argument. Here is the honest bottom line. Bitcoin is scarce, decentralized, and genuinely novel. It is also volatile and tightly tied to risk appetite. In 2026, it did not act as a haven. Whether that ever changes is still an open question. The data, for now, says judge it by behavior. One last thing, and it matters. This is analysis, not investment advice. Crypto is risky. Only you can weigh your own choices. Never invest more than you can afford to lose. We just follow the money and the evidence. If this helped, subscribe for the story behind the numbers. This has been Chronicle. We'll see you next time.